The Independent Commission, looking at ways to prevent another financial crisis, says banks that take too many risks should, in future, be allowed to fail and not be bailed out by taxpayers. In his interim report, Sir John Vickers says the parts of banks that deal with ordinary customers should be ring-fenced and told to hold enough cash to withstand any future shock to the financial system. But, as our business editor Robert Peston reports, critics say the proposals don't go far enough.
Are you taking me? Are you asking me for a critic?
The great banking crash of 2007 to 2008, and today the most ambitious plan to date to make sure that as and when banks go bad again, the cost to taxpayers and to the economy won't be nearly so huge.
Taxpayers should not be on the hook for the banks. So reform is needed to make banks better able to withstand losses and easier and less costly to sort out if, unfortunately, they still get into difficulties.
The central proposal is to split banks' retail operations from their investment and trading activities, but not by breaking them up, by putting in place a firewall to protect our savings, business lending and the transmission of money when things go bad in the other bit of the bank.
John Vickers has produced his report. I recommend everyone should read it. I think it's a very, very good piece of work. And, of course, we've now got to wait for his final report in September.
It's a tough report, and I think that people in the banking industry will find this very difficult. But I think it is right for the Independent Commission to say we will take the actions to make sure this financial crisis cannot happen again.
But a former banker believes the Commission could and should have been tougher.
Where it fails, for me at any rate, is that when it comes to the crunchy bit of hard and fast proposals, they just step back from the brink, and in my opinion, at any rate, they leave far too much wriggle room for the banking industry.
Markets definitely think you've bottled it, and the share price of banks are up very sharply this morning.
I absolutely reject any notion that we've bottled it. Reforms on these lines, and I stress it's an interim report, but reforms on these lines would be very, very far-reaching.
The Commission also wants to increase the amount of equity capital banks have to hold as a shock absorber for when they incur losses. The new international minimum ratio of capital to loans and investments is 7%. However, the Commission thinks for the biggest banks and for retail banks, the minimum should be 10%. That's far less than the 15% suggested recently by Bank of England researchers as what's necessary to make banks safe. Bank bosses, those who run the enormous institutions in the City of London behind me, tell me they fear that the reforms would push up the cost to them of doing business, and some of them have been muttering about relocating their HQs abroad to escape the reforms. Now, the Commission says that the banks have been exaggerating the increased burden that these changes would put on them, and it also believes that if the odd bank moved its HQ abroad, the impact on taxpayers, the impact on the British economy wouldn't be very great. And there are proposals to increase consumer choice of banks and bank services by stimulating competition. The Commission recommends that Lloyds, the biggest bank for personal customers, sells more branches than it's currently doing. And the Commission aims to make it easier for us to understand the costs we're being charged for current accounts and speedier for us to switch banks. If banks' costs go up, will they pass them on to us? Possibly. But for the Commission, that wouldn't be a bad thing if it discussed the kind of reckless lending and investing spree which led to the great crash of 3 years ago.
And Robert's with me now. Robert, just there, you talked about bank costs possibly going up. What could this mean for ordinary account holders?
Well, not a great deal in the short term, but in the longer term, and this, frankly, may upset the very many people who are struggling to pay their debts, the many businesses who have got too much debt on their balance sheets. In the long term, the whole point of these reforms is to push up the costs for banks of borrowing, which in turn may well make it more expensive for us to borrow. Now, here's why. In the boom years, banks were able to borrow too cheaply, and that was because there was an understanding that if they got into difficulties, taxpayers would bail them out. There was, in that sense, a taxpayer subsidy. That was incredibly dangerous because it meant banks had too much access to capital and finance, and they were able to lend far too much too recklessly. The Commission wants to get rid of the subsidy, and we all know that when a subsidy goes, costs go up, not just for the banks, but probably for us too, and that would probably, however, strange as it may seem, be a good thing.
All right, Robert, thanks very much. Thank you.